Facebook.
Right, we live.
What's going on, family?
What's going
How's
on,
everybody
Facebook
doing?
world? What's going on, Zoom world? What's going on? My name is Trevor Evans, and welcome to another fine edition of Fathers and Finance. I am one of your hosts, Trevor Evans, along with the wonderful Isaac Crumley. We got Marcus Hunt, and we have somewhere coming on soon as Patrick Gray. Is Patrick coming on today?
Yeah, he should be.
Yeah, he should be on.
We'll bring Patrick in when he comes in, when he gets on. So hopefully everyone out there's having a good Tuesday. So we had our first collab last week. How y'all think that went?
Oh man, I love the collab last week, man. I thought it was great.
Yeah, for sure.
Yeah.
Got a lot of feedback from it.
Yeah.
It definitely was.
Very much enjoyed it.
On a topic that was kind of very interesting, to say the least. What's up, Patrick?
What's going on, Trevor?
Doing good, man. Doing good. So we're gonna definitely do that again. We're gonna try and do a collab every month, because people liked it, people loved it, and they want to see more of it. So we'll definitely try and bring that to you guys every month from now on, where we collab with ladies and just talk about things that that both sides are very, very passionate about. So
Sure.
just like tonight's topic, right? Tonight's topic is mostly on that word called taxes, right? Taxes. And as you know, people always say there are two certain things in life, right?
Death and taxes.
Yeah, death and taxes.
That's it.
And it's so weird because taxes and death play a part, because if most people don't know, there is a death tax that we all pay, right? Well, I won't say all pay, because there are some wealthy that don't pay the death tax. Want to know why? Because they never die. So so why pay a tax that you never had to create? You're dying. So yes, death and taxes. So if you don't have any, got your pens and paper, okay, get ready, because this topic is going to be very, very, very lit. You can learn a lot about taxes in respect to policies and just in general, just about taxes in general. A lot of things that most people may not know. And so I will say this, because I will say it again throughout the show today, is information that you hear about taxes, whether it's with a policy or just in general, is just that. It's just information, right? I'm not a CPA, neither is Patrick. Patrick, neither is Isaac, and neither is Marcus. So
Trevor, you went to mute, brother.
Here we go. This is all information. So again, it's not instructions, it's all information. So Isaac, why don't you go ahead and kick us off on this nice topic tonight?
Awesome. So one of the things, brothers, that we gotta try to make sure that we take advantage of, we really need to try and I guess what's the best word? We need to educate ourselves, I guess is the thing that I'm looking for, on how we can put ourselves in a better position. But to put yourself in a better position, you got to know what that better position is. I mean, unless somebody comes along and tells you, you won't know. You won't know what a tax now, tax later, tax advantage type strategy is if somebody doesn't come and assist you with learning what that is. You don't know where to put your money. You don't know where to and I'm not talking about put your money as in something illegal. I'm talking about putting your money in something that can actually benefit you later on down the line. And in some cases, it benefits you in the short run. So if Tanisha, if you wouldn't mind putting that first slide on for us, and we'll hop right into it. So the very first slide, we're talking about, taxes. You make money. And this is all about, this statement here is what one of the founders of this country set up for us. You know what I'm saying? He's the one that set this up. He's the one that knows. But, it says they make money, you make money, they tax you. You spend money, they tax you. You save money, they tax you. And you die, they still tax you. They're coming at you from every which way. So you got sales tax, the income tax, the property tax, the estate tax, every other tax. Even those things that you do for leisure, is a tax. How many of you out there and on Facebook land, how many of you play the lottery? If you play the lottery, that's a tax. It was how the government said, how can we get the people are tired of taxes? Oh man, I'm tired of taxes. And the government said, how is it that we can get people to give us more money without calling it a tax? Think about it. If the government, right here recently, I think at the beginning of the year, guys, wasn't it January that they had almost $1 billion in the lotto? It was close to $1 billion, right? If I'm not mistaken. Now, if they were willing to give away close to $1 billion, how much money did they make during that time? They made well over $1 billion if they were willing to give away $1 billion. So the way that you want to try and structure your life is to be in a certain tax bracket. One bit is, I'm gonna read right here. One bit of good news is that the highest current U.S. federal income tax rate is rather low compared with the past. It was over 90% during President Kennedy's time, and it was 70% at the beginning of Reagan. Today, the top bracket is lower, but if you add state income tax, the total may be higher. Of course, obviously, we want to go to irs.gov to find that out. Let's move on to the next tax. Next screen, rather. Next tax. That's what it feels like. What's the next one? All right. So what we want to talk about now, and I'm really just kind of want to focus down here on the bottom. Well, you know what? I'll go ahead and cover the capital gains, but the focus tonight is really going to be on that bottom. Almost everything you own and use for your personal investment purposes is called a capital asset, like your home, stocks, bonds. So when you sell a capital asset, the difference between the amount you sold it for and your basis is which is actually what you paid for it, is the capital gain. So in other words, if you bought a house for $100,000, you sold it for $150,000, that is your capital gain. Capital gains on assets held for less than 1 year is a short-term gain and usually taxed at ordinary income tax rate. So that's a little bit of game right there. Go ahead, Marcus.
Trevor, help the audience understand what exactly is capital gains.
Well,
Okay.
I mean, man, it's just kind of like I just read there. You know, for instance, if you just bought a house and you bought that house for $150,000, in this case, you know, in this example, well, we'll do both examples. If you sell a house, let's say you flip it, let's say you bought an investment property for $100,000, you put $30,000 into it, and you flip it in less than a year at $200,000. Well, that's a capital gains, but that's a short term and it's taxed at the usual rate. But let's say you held on for it for a while, then it's going to be taxed at a higher rate. That particular capital gain would be taxed at a higher rate. So that's what we're going to get it. I mean, that's kind of an example of capital gains, but that example right there, that what we just read, that is the actual definition. So what I want to talk to people about is what we really don't know is the tax now, tax later, tax advantage strategy. And with me typically, man, the most I ever thought about was tax later, and that was my 401k. So tax now is something that's going to be taxed this year. Your checking account, your savings account, your CD, stocks, mutual funds, any gains on that is going to be automatically taxed right off the rip. The most I ever really thought about it, and I don't know about you guys, in the beginning, I was at the 401k, and I knew a little bit about annuity, but I didn't know not a lot about annuities. But an IRA, SEP, IRA, I didn't even want to know about that. That sounded too complicated to me at a certain point in time. One job I had did have a pension, but that was early on in my working career. You know, almost everybody's got a 401k now and not a pension. And I certainly didn't know about a long-term care benefit. All of those strategies are taxed later, which simply means the government goes, all right, man, it's almost like a loan shark. Loan shark gives you some money, and he's going to be like, hey, man, I'm coming back to collect. You kind of smile there, Trevor. Does that you like that example, brother?
Loan shark?
Like how the loan shark comes back to get you later?
I do, yeah.
Because that's the government. I mean, that's for real. That's the government. You know, man, if the government owns you 10%, you owe the government 10 cents, a dime, they're going to come ask you for that 10 cents.
Mm-hmm.
But if they owe you something, bro, they're going to be slow as dirt as getting that money back to you. But they definitely like a loan shark, you know, on that tax later. They're coming to get you, and we'll get into that in just a moment. They're coming to get you a little later. But then your tax advantage strategies, this is where we want to live at. And that's your Roth IRA, your 529 college savings, your municipal bonds, your health savings account, and your life insurance. And in particular, everybody on this panel, all of our favorite life insurance policy, which is an IUL, which is basically creating your own bank. So let's continue to move forward. All right, so let's just simply go over this. So that tax now means any earnings received from these accounts must pay tax that year. For example, savings accounts, CDs, dividends, stocks, mutual funds, money market funds must be reported and pay tax. In Canada, that would be guaranteed investment certificates or GICs. Term deposits and any investments or savings generally held in a non-registered plan will fall into this category. Most people I know use these type of strategies right here. I mean, just our family members. The most that we may have is 401ks, but most of us really are falling into this example, right here: checking account, savings account, CDs. We really aren't trying to do much outside of that. And most of us are looking for a job that's going to give us a 401k. So these are kind of where we're at. Let's move on to the next one. Now, tax later means that you put money, the money that you put in is pre-tax. All right. So that could be a 401k, 403bs, any registered educational savings plan. All of that is come later. That's where they get you later. In the US, when you begin to take your money out after 59 and a half, age 59 and a half, you'll be taxed at ordinary income. But if you take money out before then, that is a 10% penalty with a few exceptions. Also, you can't keep your money there forever. You must withdraw it when you reach 70 and a half. So that's a problem, fellas. That's a problem. So you got to wait till you get to 59 and a half. If you try to take it out before then, they're penalized. It's your money. And they're getting you at 10%. It's your money and they're getting you at 10% with a couple of exceptions. And then you can't keep it there. You got to get it out by 70 and a half. That's why I like the IUL. As Trevor, what's your term for it?
Royal flush.
Royal flush.
Royal flush, yeah.
That's the royal flush. Not only do you have the protection with the IUL, you can take that thing out. Literally, if you're still working at 70 and a half, you don't have to touch it. There are no rules. And then you can slow drip that thing out for the rest of your life. Last thing you want to do, I'm getting ahead of myself. I'm doing the tax later, but I'm getting ahead of myself, but I love it. Let me just stop. We'll get to that in just a second. Most tax later accounts are designed this way. However, some tax later accounts are tax deferred, but not tax deductible. For example, the money you put into a non-qualified annuity or a non-deductible IRA is after-tax money, which is non-deductible. The tax only begins to apply, the tax only applies to the gain at withdrawal, which has been tax deferred. So in other words, when you need it the most, that's when the tax comes in. All right, let's move on to the next one. And I'm assuming this is my favorite category. Tax advantage, there I go. Royal flush. Tax advantage means you generally won't pay taxes when you withdraw the money from your account. Tax advantage investment money is after-tax money because you've already paid taxes on it. Roth IRAs, 529 college savings plans, TFSAs, and life insurance are popular investment vehicles that get tax-exempt distributions. Now, fellas, let's stop here for just a minute. Most people think that life insurance is just a death benefit, that, as long as you die, when you die, that's when your family gets the money. And most of you guys have heard me talk about the frustrations that I have with people that talk about they don't want their children to get rich, or they don't want their wife to come up, and be dating some other dude with insurance money and all that type of foolishness. But this protects you from all of that. This literally, the IUL protects you. Number one, it gives your family a death benefit. But number two, let's say you get hurt are injured and you can no longer work, you can take that money out right now to take care of you and your medical bills and your living expenses. You can also use that money as you retire, and it does not get taxed at all. I mean, to me, man, I don't know what else can be better. Obviously, there are other things that you can invest in, and those things are good. I'm not saying that they're not good, but my goodness, man, this thing is, when you start talking about tax advantage and getting later on in life, this is the best thing for you to have, in my opinion. I don't know about you, Patrick, but has that been working for you? I know that you recently started doing some things for your daughter with an IUL. Is that right?
Yeah, that's right. That's right. I got it when she was 1, so I've already seen a pretty decent return on it on just the first year. And I'm gonna keep it in there and see what she wants to do with it at 18. But I really want to release it to her by 25. But we'll see. We'll see how that turns out for me. But the IUL is just like you said. It's a full flush, man.
Right.
It
And you
it
know
does
that,
everything that you need. It does everything that you need it to do without going to this to accomplish one thing and going to something else to accomplish another. All those vehicles do certain things to help you in different ways. Where this, you get it all in one package. So
you know,
it's not it.
I look at you, man, and look at you how you talk to your baby girl and how she's got you wrapped around her finger. I see the love that you have for her when you're holding her, when we're doing the production meetings or what have you. And trust me, brother, what you're doing, you're not going to be able to stick your chest out any prouder when you about yourself and what you've done. When you realize that you have set aside some money for a future, that you took care of her for the future, man. I mean, I know people, man, that pay college off with this. And right now, if you were to invest in a 529, Patrick, most people would be doing a 529 right now. But that's reportable income that comes off the FAFSA when you go to school. But that IUL is not. That is life insurance, so it does not get counted as income.
Mhm.
So you're doing a great thing, Patrick.
Yeah.
I appreciate that, Isaac. I feel like that too myself. When I started, the first guy, I said,
patted yourself on the back.
I'm doing a pretty good thing.
No, that's
it's
right.
amazing. It's definitely amazing. An amazing feeling to know that you can set something up. I wish I would have heard about it sooner. That's the only thing. For her, right on time. But for myself, I just wish I would have heard it sooner. But hey, we live and we learn, don't we?
We live and we learn. We live and we learn.
Yep.
Marcus, I know you get ready to do that for your children as well, right?
Oh, of course. Of course. For MJ, he's 4. My daughter's 2. So yes, sir. Of course.
That's right, man.
Gotta make sure they're good.
It
feels amazing to know that you know what I mean, that they're gonna be good. I wish my parents had this in place for me.
right.
It's all good. You know what I mean? We just do what we gotta do. Definitely.
Right. Well, I know that I'm about to have a granddaughter, so that's certainly one of the things that I'm getting ready to take care of for her. I'm already planning on being just a rotten granddad. You know what I'm saying? I'm as I told y'all in the production meeting, I got some nice country sayings that I'm getting ready for, to tell her. Just be an old head, you know what I'm saying? So I'm getting ready for that. But one old head thing I'm not gonna do is not take care of her. I'm gonna make sure that she's got. I'm gonna set that IUL up for her so that she'll be ready. She's gonna be brilliant. I automatically know that. But some people don't need to go to college. They may already be ready right off the rip to start a business, and if they don't have to go to a bank to go get that money, I want to be able, as her grandfather, to have that ready for her. But if she does want to go to college, absolutely, I want to have that college paid for her. And then I already know that that's not going to be viewed as income. So whatever I need to take out for her, I can take out for her and make sure that I give it to her. And as she gets siblings and my other child has children and all that type of stuff is just going to continue on. And I'm going to be known as that granddaddy that took care of him. You know what I'm saying? So I'm certainly appreciative of that.
Yes, sir. And now, Isaac, with the whole tax advantage, tax down, tax later, and would should we, well, do you think it's a good idea to avoid paying the taxes now and wait till later, get them deferred, you know, when you get older, or pay them now and get the taxes out of the way so you don't have to worry about them later?
Well, the smart thing, and I don't know what the next. I think we got. I don't know if we got the X curves up there, and that will probably give people a good visual. But the thing to do is try to pay as little tax now as possible. But it would be better, of course, to pay taxes now as opposed to later. I mean, the last thing I want to do when I retire is have a gigantic tax bill. You know, we recently did. A program for a woman with a 401k, had $1.2 million, but she got a huge tax bill on that. And so when she received her money, she didn't get the full 1.2. Now, I mean, nobody's sneezing at what she got, but still, if you earn 1.2 million, you want 1.2 million. But the government came and was like, "Oh, that's what you want now? That's what you think you want?" You know how Denzel, oh, that's what we're doing. You know how he does that. You know,
And there you
Right.
right.
That's how we doing?
That's how they did. That's how they came and did Zelda. You know what I'm saying? They came and did Zelda and took her money. So the thing we were trying to do for her, you know, she had to take a tax hit at the end when she's retiring. And then we had to restructure something for her so that she could, so that she wouldn't have to take any more hits and she could gradually take that money out as time goes on. I don't know if Tanisha's got that X curve up or not. If she doesn't, then that's fine. But oh yeah, there we go. So the younger you are, on the blue line, if you everybody that can see it, that blue line, you know, as younger you are, you're taking care of your family. As you get a little bit older, you're trying to take care of your future, but you're generally more secure. Technically speaking, you're supposed to be more secure. You've got more responsibility as you're younger, but as you get older, that black line goes down. So you got the children out of the house. You're getting ready to do what I'm getting ready to do, which, you know, I got about to have a grandbaby, so I want to spoil her, but then send her on back to her parents because that's not my responsibility. I just want to be, you know, pawpaw, love her, and then send her on back. So about that responsibility decreases. So this is kind of where you want to be. So to answer your question visually, I don't want to be paying any taxes as I get older. I just don't. I just want to have my money come out. And if I earn $1.2 million, I want $1.2 million. I don't want Uncle Sam coming after me. And most people go, well, I didn't know I had a choice.
Yep.
They didn't know they had a choice. And that is why Fathers and Finances is here. We want to let you know that you have a choice, that there is something that you can do about that. Trevor, you've been quiet, my brother. What you got to say on this?
You know, everything is all specific to you know, whether it's a policy or a vehicle of some type. But taxes is if people truly, I mean, we're all going to pay taxes, okay? And you know, the truth of the matter is, whether you're rich or whether you're poor, you know, you want to pay taxes. The difference is how much you're going to pay, right? How much you're going to pay, because most people don't understand that the, you know, taxes is really designed for you to decide how much you want to pay in taxes, all right? But because so many people know so little about taxes, they actually believe that what they pay in taxes is what they're supposed to pay. And what I'm saying is, most people believe that they get a tax bill that says you have to pay X amount. Now, I'm not saying that that doesn't happen, but it does. When we truly understand taxes and how it works, it's really set up for the citizen to pay what they want to pay as far as taxes go, okay? And that's a completely different argument that requires a completely different type of thinking, because taxes is not, if you ever notice the wealthy, you know, people used to ask me all the time who I vote for, okay? And whether I voted or not doesn't matter, okay? I tell them, I say this: if you're wealthy, it doesn't matter who's in office, because the rules don't change for the wealthy. all right? So I don't care who's in the office, okay? The only time that you'll see a wealthy person, truly vote is when they want to change something about the tax bill or tax law, all right? Because up until then, nothing happens for the rich, okay? Because they know how to really maximize the tax law. So taxes is really a fascinating thing, and it is a system that is designed. If you truly knew taxes the way that it's supposed to be known, the tax law can tell you how to keep every single dime that you make. All right, and you pay the IRS, or you pay, what you want to pay, and that's how taxes are. And a lot of the tax knowledge comes from tax myths. Okay, so I'm gonna go over a few of these tax myths, in my segment, because you'd be surprised at what people believe that really is not true by law.
Brother, I'm glad you're gonna go over that, brother, because and again, just so we can plug this show here, we want to drop nuggets to people. And it's not like all of us woke up every day like we had this. We didn't just have this, as Trevor has mentioned previously on the show, when we were Marcus's and Patrick's age, we made mistakes. We got, we did good stuff and we got knocked down. We did bad stuff, we got knocked, but we came back, and you learn these things. And whether you learned it through, as my mother said, you can either look at somebody else's mistakes or you can buy those mistakes for yourself. What we're trying to do is make sure that you don't buy those mistakes for yourself. We're trying to make sure that you can look at any of the mistakes that we have made and learn from what we have done. And again, I want to reiterate, as Trevor reiterated, this is information. We are not tax attorneys or anything like that. We're not giving you instruction. This is information that you can use and share with your tax attorney or whoever it is that does your taxes. But this is what we are trying to do, family. We're out here trying to educate people. It's that WSB life, WSB, WFG, financial independence. And we're certainly trying to do it for our people. We're not excluding nobody, but we certainly are going after our people and trying to make sure that we do it. So what are some of those myths, Trevor, that we want to discuss? One of the main ones you want to knock down.
When I say myths, I don't mean as far as, that doesn't exist. I mean more of a misunderstanding. Okay. So, for example, all right, people, the one topic, when I teach, I'm on the weekend and I'm teaching, I swear, the one topic people want to know the most about is taxes, right? And it baffles me because that's the least topic people know about, okay? But it's the one topic that everyone thinks that they know about, right? So I'm gonna tackle some of the facts about taxes, all right, to let you the basis of what taxes are, because taxes is very, very deep, all right? Now, does anyone know what the tax code is called?
The legal term?
Yeah.
Man, no, I call it that demon tax code.
All right. So first of all, the tax code was first published in 1926. Okay. So
there you go with the dates. I should have known, brother.
There you go. So the U.S. tax code is actually called Title 26. All right. All right. So
I have heard that. I just didn't remember.
There you go. So Title 26 are the laws that the IRS enforces. Okay. Now, first and foremost, the IRS doesn't tax us. All right. Okay. The IRS doesn't tax us. The IRS enforces the what? The tax laws.
Code.
Okay. Exactly. Now, we also do not pay the IRS. All right. The IRS is the enforcing body, okay, to enforce what? The tax laws, all right? So when you pay taxes, who do you pay?
IRS or the government.
Now y'all should know, because every year, what do y'all pay? Taxes, right?
Right.
Yet you have zero clue who you actually pay. Okay, this is what I mean by if you learn the rules, what's the one thing they cannot insult? Your intelligence. Okay, all right. Nobody pays the IRS. All right, the IRS is the enforcing body of the tax law or Title 26, but everyone pays the United States Treasury.
Yep.
Right, that's who you pay your taxes to. Okay, you don't pay them to the IRS, and you don't pay them to the government. Who do you pay them to?
Treasury Department.
Yeah, exactly. United States Treasury. That's who he paid to. Now, you're paying all these taxes, right? Right?
Right.
What are the taxes paid for? Does anybody know?
I know what they are supposed to pay for.
Okay, I will tell you. Okay, I will tell you. Out of the taxes that you pay, 50%, 15%, okay, goes to pay for defense. All right, defense of our nation. Okay, 24% pays for what? SSI, Social Security. Okay, 26% goes towards healthcare programs. 9% goes for those in need, programs, you know, that help the needy. Okay, and 20% goes to pay for our veterans and retirees. Right, so that's where your money is going when you pay the who?
U.S. Treasury.
U.S. Treasury. 15, 24, 26, 9, 66, and 20. They go to pay for defense, Social Security, healthcare, national debt, 6%, veterans and retirees, and then those that are in need. So that's
Trev, I got a question.
yeah.
Are those the current percentages? Or is that what was supposed to be, how it's supposed to be broken down?
That's how it's supposed to be. Yes.
Okay, gotcha.
Yes.
I'm getting all
Grand
right, cool.
total of what the Treasury Department brings in, grand total, okay? 20% of that goes towards our veterans. Now, that could be paychecks, bonuses, you know, VA type stuff, all right? But as long as it's veteran, you know, VA loans, okay, right? Things like that. So that's where our taxes go, okay? Now, the tax Title 26 is probably about 75,000 pages long, okay? All right, it'll take you about 90,000 minutes, okay, to read that, the entire tax code nonstop, right? That's 1,500 hours, okay? That's 2 months and 2 days, nonstop, okay? 8 weeks straight, right? That's how long it will take you to read Title 26, all right? Which is the tax code. Now, most people don't understand that taxes are not due on April 15th, all right? Taxes are due on December 31st of every year, and they're late January 1st of the following year, and then they're overdue if not received by April 15th of that following year, all right? So taxes have never been due on April 15th. Taxes are due on December 31st of that calendar year. The only entity where taxes are due on a different date than December 31st is a C Corp. And of course, taxes are due in a C Corp on the inception date of the anniversary year. Meaning, if you created that C Corp April or let's say June 18, 2021, taxes are due June 18, 2022. But everyone else, taxes are due when? December 31st of that calendar year, and they're late January 1st of that following year. Now,
well, when is the April 15th come in?
That is the deadline before you're overdue.
Right.
Okay, because anything before that, there's no need to file a what? An extension.
Extension.
Yeah, okay. After April 15th, you gotta file a what?
Extension.
Because you're overdue. Okay, you're overdue. So most people that understand taxes, they get ready for tax time around October. All right, October, while everyone else begins when? January, maybe February, okay? Depending on if they want to check or not. Now, that's one myth. Another myth that people understand, think about taxes is that they think that the government taxes our money. right? And the government does not, okay? The government does not, neither does the IRS. And the reason why is because it's against the law for the government to tax our money. It's been that way since 1913, okay? So how the government gets around that is when you're filling out your taxes, your tax form, okay? The first question that's asked of you is, how did you earn this money, all right? So if you earn that money as a W-2 employee, if you earn it as a 1099 employee, if you earn it as a business owner or business system, or you earn it as an investor, that's how you tell the IRS how you earned your money, because that's how the IRS taxes you, okay? So the IRS does not tax the money that's earned, okay? The IRS taxes how the money was earned, okay? So if you tell the IRS, I earned it at 1099, you're probably gonna pay somewhere in between 45 to 64% in taxes on that money. If you told them you earned it as a W-2, you're around 32, 34%, total in taxes for that quadrant, right? If you earn it as a business owner or an investor, the numbers go down to 0 to 7. And the reason why is if you got 4 quadrants, the E, the S, and the B, and the I, the right side of that quadrant, the E and the S, that side earns money, okay? On the right side, the B and the I, that quadrant doesn't earn money. What's it do? It creates money and then spends it. Because on this side, you are taxed on what you earn gross, and then you spend what's left over, i.e. net. On the right side, okay, you earn your money, you spend your money on expenses, and then you're taxed on what is left over, right? So how
Right.
fair is that? How fair is that? Over here, you earn $100,000, right? You're taxed on that, and you're gonna spend 60 or 50 or whatever. On the right side, you earn 100, you spend 95,000, you're taxed on what?
5,000.
5,000.
That's the side I want right there, Trevor.
Facts.
I want that side, brother.
Yes, sir.
Right, right. So most people tell their kids, don't make a lot of money, because if you do, you're gonna pay a lot of taxes, and that will be true if you earn that money where?
Left
On
side.
the left side, okay? Either ES side, all right? If you earn it on the right side, all right, not only you pay less in taxes, but you will pay less in taxes on a lesser amount, okay? Because what the government is doing is the government is giving you full access to your money before it's what? Taxed. So everything on the right side that is bought with your money is bought with pre-tax dollars, which means your money goes farther than it would on this side, because you're now forced to live off of post-tax dollars, right? So it looks like this. If you earn 100, how much of that 100 do you want to spend? All of it,
Right.
Right.
right? You won't be in tax, right?
Right.
Well, on the right side, that's what they're saying. You earned 100, okay? If you spent 100, guess what you don't owe?
Taxes.
Tax
So,
it.
so
Tax it.
just so that I'm putting this in the layman's terms, certainly we understand it. But
Yeah.
as an insurance agent, you're a brand new insurance agent into the market, Trevor, and they give us the opportunity to either get paid as an individual or to create a corporation and get paid as a corporation.
Mhm.
And you're telling us, just so we're putting it in layman's terms, that we should get this. You're free to get paid as an individual, but if you're smart, you'll get paid as a corporation, because if Transamerica or Mutual of Omaha, whoever I'm working for, gives me $100,000 and I spend that $100,000 and down to I spend $97,000, I'm getting taxed on how much?
3,000.
The remaining
3,000.
3,000. Right. Because if you
So
look at it,
why are we
okay,
taught then, Trevor, to go in and get that W-2?
because here's on this side, okay, how do you pay taxes? What do you pay taxes on? On money that you earn,
Earn.
right? Okay. Slavery, okay.
Right.
On this side, right? What are you
Exactly.
taxed on? What are you taxed on?
What's
Money
left?
that you
Yeah,
left on this side, you taxed on what?
Money that's
that you
left.
left that you leave. Yeah, exactly. So if I want to leave $5,000 left over out of the 100,000, then I'm gonna pay a lower rate on 5,000. Okay, that's how the tax code is designed. Because on the right side, all right, it's a business that's creating the money. Okay, a business does not earn money. A business what? Creates money. Okay, okay. So a business does not do work. You get it? If a business does work, what side of the quadrant would it be on?
Left.
Like you said, the left side is how it's done.
Yeah.
Right. So that's why a LLC is taxed on what side? The left side. Okay. The S corp taxed on what side? The right side.
Right side.
Okay. Why? Because the LLC does the work. You feel me?
Yeah.
Right. Okay. Companies do work. Corporations get paid and spend money.
Right.
So slow that down again, because I got you. We had this talk already, but there's a lot of people out there right now that are being encouraged to do LLCs over S corp and C corps and all of that. Yeah. And I get it, and I want to be clear again. This is information,
right?
And we want to make sure that that's information. And there's nothing. I don't have a problem with LLCs, but slow that part down again for us, Trevor, because I really want people to understand what you're saying.
Okay, here's a big myth. Here's a big myth among people. Most people think that an LLC is a business. All right, it is not. A LLC is a sole proprietorship. Okay, and the LLC came about in 1978 when all of your self-employed people, your contractors, your roofers, your electricians, okay, they wanted to be viewed as a business. Okay, and the IRS said you're not a business because you do the work. Okay, so if you do the work, okay, you are the what? You are the company. Okay, if you don't do the work, does the company get paid? No, right? As an employee, if you don't do the work, do you get paid? No, no. So a LLC is a limited liability company, right? You are the company is you because you are most likely going to be the managing member of that company, all right? So the LLC does the work, the labor part of the business, okay? The corporation does the what? The financial part, the business part of the company, all right? It gets paid the money, it spends the money, all right? And then passes that money on to be taxed. So how it should look, all right, for any business, whether it's a investor, whether it's a agent, whatever, your LLC is a company that does the work, all right? Because if this company does the work, right, and also gets paid the money, if someone does not like the work this company did, can they sue that company? Yes.
They can.
Why? Yes, because the money is in that what?
That company.
In that company, okay? It has assets, okay? So you don't want to do that, all right? So you want to create an LLC that just does work. It doesn't get paid any money, all right? The corporation is who you will pay, okay? So if you want, create the company Trevor Evans LLC, right? That's who came to do the work. However, ma'am, you're gonna pay Trevor Evans Inc., right? That's who will get paid the money. So if I mess up something, right, and that customer, that client wants to sue me, who did the work? Trevor Evans LLC. Not Trevor Evans what? Inc., okay? Trevor Evans LLC did the work. So who could she sue?
LLC?
Trevor Evans LLC. Well, what's in that LLC?
Nothing.
Nothing.
LLC is the worker.
Exactly. So my asset is protected where? In the corporate side.
Yeah.
All right. Okay. That's the purpose of the LLC. So the LLC is tasked to do work, all right, all payment of that work should go to the S corp, all right? Now the S corp can now, so now it makes all the money, okay? The S corp now spends all that money, right, or most of it, okay? And then the S corp will file what's called I'm going to blank here, a K1, okay, a K1, okay? What a K1 is, so here's another myth. S corps do not pay taxes, all right?
Can I give
S
somebody
corp,
an example of that, Trevor?
huh?
Can I give you an example of that?
Can you give me
Of
one?
what
Sure,
you're
go.
trying,
Yeah.
okay, so y'all are familiar with Amazon, correct? You get
Correct.
packages, you order
Yep,
packages.
Yeah.
yep.
All right, that company that delivered you that package, I know it says Amazon on the back on it, but they do not work for Amazon. They
Mhm.
work for a DSP, which is a LLC. And now S Corp is Amazon. So they have the logo and they have all of that. So when they say you wanted to sue a driver ran into your and you want to sue Amazon. Amazon
Can't
is
sue
not getting
Amazon.
sued.
Can't sue them, right?
Yeah, you're not going to sue Amazon. You're going to sue the company that works for Amazon.
Right,
If,
Right.
right,
if that makes it
right.
if that makes it a little bit more clear for anybody that didn't really understand exactly what he was talking about. So that's just putting it in another picture. Well,
Okay.
you can go
So
ahead, Trevor.
Isaac had a question that was asked to him from Justice Israel. He said, "Is working as a contractor be equal to taxing on a business as a business owner?" Again, I am not a CPA, nor do I play one, nor do I act like one. Okay, I am not. All right. Okay. If I was sitting in front of Isaac and Isaac asked me this question, all right, I would tell Isaac, I'm sorry. If you are a contractor, okay, and you work for an LLC, no, you do not have a business. All right. Even if that LLC has a tax ID number. So most people say, well, damn, why do I have a tax ID number on my LLC if I'm not a business? Okay, well, I'll tell you why. Your intelligence is being insulted. Okay, first and foremost, in order for an LLC to have a tax ID number, that LLC must file IRS form 2553. Okay, that is a form that is filed by the LLC, which allows the LLC to be issued a tax ID number. Even though the LLC has a tax ID number, it is not a business, because here's why. At the end of the day, all right, if that LLC made money, okay, and it expensed off some expenses, it passes that money on to who? The managing member of that LLC,
The
which
sole
would be
proprietor.
you as the individual, a sole proprietor, and you're now going to be taxed at what? At that individual rate. So if you want to know if you're a business or not, okay, the easiest way to know is to figure out how you're taxed. If you're taxed on this side of the quadrant, you are not a business. If you're on tax on this side of the quadrant, you are a business. Okay. So if the LLC has a tax ID number, it does not make it a business. What it allows the LLC to do is it allows the LLC to claim expenses like a business, but it is still not a what? A
Business,
business.
because
Okay.
it's paying money on the taxes earned, not left over.
Right. Right. Exactly. So just because you have a tax ID number does not mean you have a business. All right. All it means is that, one, you're probably not maximizing that 2553 declaration, okay, to the fullest. Okay. Because do you understand what it means to expense like a business? All right. I'll tell you, on the left side of the quadrant, W-2s, 1099s, and LLCs. In order for you to expense any expense, you must provide proof of the expense, and expense has to be tied directly to that business purpose, okay? and you must have a receipt of the money that you spent. So you must be able to provide proof that you spent the money, and it must be a legit expenditure on that company or LLC in order for it to be a legit expense. If you want to claim an expense on the business side, you could do it through a receipt factor or receipt fashion, okay? But most likely you would do it on what's called an invoice, okay? And if you don't know what an invoice is a document, okay, that says I created expenses of X amount and I charged it to this company or this person, all right? That now allows you as the business, the corporation, to expense whatever the invoice amount total was to whoever you charged it to. You with me? Okay, so you don't need proof that you spent the money, okay? You just need proof as to why you're what? Expensing the money, all right? So I always say on the left side of the quadrant, you cannot make up expenses. They gotta be what?
Real
Proven.
expenses. Right.
On the right side, what could you do?
Again, this is information.
Yeah.
This is
right
information.
side, yeah. So on the left side of the quadrant, you cannot make up expenses, right?
Right.
So naturally, you would think that you can make them up on the right side, right?
Can't do that either.
Can't do that either. Okay.
Invoice.
You cannot make up an expense, but you can justify an expense.
So
Does that make sense?
So I want to get into this because we had this in our production meeting. I think that's a good segue into this question. So when I got out of college, I worked in Florida for a while, but my first job here in Atlanta, a man gave me a shot as a controller. And the one thing that he did that blew my mind was that he bought cars for himself and his wife. And his wife was she didn't work in the business, but she was part of the corporation. So he bought his cars through the corporation, and he bought his house through the corporation. Now we were discussing the tax implications of that on the meeting, but I was interested to hear what you thought about that, and I think people need to understand because there's a different way that needs to be done as well. Like that just can't be done. I mean, I guess you can do it,
You can
but
do it,
but some things are not to be done. Just because you can do it doesn't mean it's to be done. So
right. Just to be clear, you cannot expense everything on the corporate side. Okay,
right.
You can't. Okay, nor can you expense anything on the corporate side. All right, but what can you expense? You can't expense anything, and you can't expense what? Everything, right? But what can you expense? You can expense anything your CPA can justify. Okay, so if I bought Saint Laurent cologne and I wanted that to be an expense, okay, my CPA will have to put that in my resolutions, all right, because that's where all your expenses go. They don't go in the bylaws, okay? They go. So if you're a corporation and you want to expense something, where does it go? It's called your resolutions. All right. All right. So your CPA will create the resolution, i.e. justification as to why you want to expense YSL cologne as a corporate expense. Okay. And it could be as simple as this. You know, the CEO of the company has very severe allergies, and he doesn't. And every meeting if I wear, you know, cheap cologne, he sneezes. But for some reason, that expensive shit, you know, don't make him sneeze. Okay, so he puts it in his bylaws. All right, every meeting, I want my male employees, okay, to wear higher end perfume because that cheap shit made me sneeze. And there's your what?
Justification.
Because whose business is it?
The CEO's business.
And can anyone tell you how to run your business?
Nobody.
Not even the IRS. So the IRS will say, well, shit, I don't want to work for y'all because now I can't afford YSL. And y'all making me buy this shit? Then don't work here. So I make sure that everyone that works here, okay, my son, my daughter, my mother-in-law, whoever, I make sure that everyone that works here, what will they wear as far as perfume and cologne? YSL, okay? If I buy it, that's now a what? An expense, right?
Right.
Because if I'm allowed to pay taxes on what I'm left over, okay, I can't buy cheap shit. Because if I do, what would I do? I will leave too much money, what?
Tax to be able to be
Left
taxed.
over to be
taxed.
taxed.
Yep.
Okay, so I got a choice. You at $20, okay, or YSL at 180. Right? I'm gonna go to the I'm going to YSL, right? Because if I don't spend this money, who's gonna take it?
IRS.
The U.S. Treasury.
Well, yeah.
The IRS is going to enforce it, and then
Yeah, they're gonna force it. Yeah.
Yeah.
But
Yeah.
US Treasury.
So the key word there as to why, how can a company spend 100,000 of what they make? Well, it's very, very easy. Either spend it or create invoices that justify the expenditure.
So a car could be, if you want to find a car, you like the executive needs a car to get around.
As long as the justification is in the what?
Bylaws
No.
or resolutions.
There you go. Yeah, resolutions. Okay, and it says that, hey, everyone that works for this company, if you are of driving age and you work for this company, you will drive a luxury model year vehicle. If you can't afford a luxury model year vehicle and you want to work for us, all right, the company will buy the vehicle and lease it to you, but you will obey the what? Resolutions and drive the car. Are you with me?
With you.
So
Yes,
if you
sir.
own the company, you're the CEO, right? The wife is in the company, the kids in the company, and it's time for your kid to start driving the car, okay? Hire her as a what? As an employee, right? And per the resolutions, what does it say? If you are of what? Driving age, you must drive a what? A luxury model year vehicle. If you can't afford one, the company will spend
We'll
its
provide one
own
for
money,
you.
not provide one for you. The company will buy, okay, the vehicle, right, and lease it to you so you can satisfy the what? Resolution of driving a luxury model year vehicle. Okay, so
That's
a
what I'm
lot
talking
of your
about.
taxable expenses will come from how your CPA justifies the expense. It's not your job to do that. Whose job is to do that? The CPA. CPA. So this topic can be, I can talk about this topic like all day, but we got 2 minutes left. So I want to wrap it up by saying this. The tax code is made for business owners, okay? All right. Out of the 75,000 pages in the tax code, right, probably about 4,000 is about employees and self-employed, all right? The other thousands of pages is all towards what? Business owners, right? If you truly understood taxes, the tax code, Title 26, can instruct you on how to literally and legally spend every single dime that you make. Because
Awesome.
literally, you only pay taxes on what? On profit. So what's the goal here? Don't make a damn profit.
Right. Make sure you ain't got no
Make sure
problem.
that everything's a what? An expense. but just make sure that those expenses are all the crap that you need too.
Yeah, right.
Right.
At
Right.
the end of the year, so at the end of the year, you spent all your money, okay, on expenses that you needed, okay, and because you made no profit, there's no what?
Hardly
There's
any
no
taxes.
tax event created.
Yeah, yeah.
And see, people, this is how you have these huge corporations that make billions of dollars, and you find out they pay little to no taxes, and you're going, how did that
Wow.
happen?
Mm-hmm.
How did GM that year? Remember GM after they got the bailout and they climbed back up, and then it was reported that they paid zero in taxes, and people are like, man, I made $35,000 and as a single person, and I ended up paying taxes. How did that happen with me paying 35 and I'm struggling to make it? And GM made billions of dollars and didn't pay
Let me
a
tell you
dime.
something. Let me tell you
How did that happen?
if because GM didn't make billions of dollars, because if they did, what would they pay?
They would have paid taxes on billions of dollars. They spent that mess.
Exactly.
They spent it.
Exactly. Okay. They spent $1 billion.
Right.
All right. Because you're taxed on what you make and what's left over.
Right.
But if
Right.
you're a business, if you're making $1 billion, you better spend $1 trillion.
I tell you. So guys, real quick, I want to, since we're almost out of time, if you're on the not on the, well, I guess on Facebook Live, Tanisha is posting it, but if you're on this Zoom meeting right now, the new class, the workshop 3 is going to be wealth management and asset accumulation. Again, we offer complimentary classes. And so if you'd like to know where to go, you can simply go to worldsystembuilder.com/WS-US. Again, worldsystembuilder.com/WS-US. So you want to make sure that you can get on and find complimentary classes for everything that we do. Again, we got one coming up called Wealth Management and Asset Accumulation. We got another one that helps you to reduce debt. We got another one that tells you about retirement planning and things of that nature. So there are tons of classes that we have, and they're all complimentary. Get on, find out about it. And as far as tonight is concerned, if you would love for one of us to get to meet with you personally and do a PFS for you, then certainly go. The link is posted is in here as well. It's kind of a whole jumble of words, so I won't even try to get that to you, but that link will be posted. Right now, it's currently posted in the chat menu, and it's going to be posted on Facebook Live, and it's also going to be posted on the YouTube channel as well. So that's it. I just want to remind everybody about that. Wealth management and asset accumulation is coming up. Any other questions?
No questions, but I have a statement. The PFS
Sure.
to make, give clarity to people who don't know what it is, because of course we know, but it's a
Right.
personal financial strategy for you guys. So
My fault. Thank you, Marcus. I appreciate it. Forgive
I got you.
the old man. So I'm gonna try one of my new old man phrases before I leave. All right, I've been practicing this, so this one I'm gonna practice. So here it is. How's it go? Ain't nothing cooking but the peas. I can't remember the rest of it. I just went blank. So I'll do that later. Hold on, wait, what was it? I've been practicing it all day. Did I get a chance to do it?
All day.
All day.
And you mess it up all day.
Oh, I know what it is. Ain't nothing cooking but the peas in the pot. And they wouldn't be cooking if the water wasn't hot. That's what it is. That's what it is. I drew a blank. So I'm gonna start using that one.
All day. Oh, you're working on that all day. Wow.
Hey, I'm better with the other one. Ain't nothing shaking but the trees, the leaves in the trees, and they wouldn't be shaking if it wasn't for the breeze. So I'm gonna start talking like that on a regular basis.
Head talk.
Charlene is gonna kill me. She's not gonna allow me to talk like that, but for so long. She's gonna choke me out because she ain't gonna appreciate it. But still, I'm just embracing. I'm just embracing my grandfatherhood. You know what I'm saying? So
yes, sir.
All right.
Awesome. Well, thank you, ladies and gentlemen, on Facebook Live for the old head giving his little moment. We will see everybody back again on Tuesday at 6:30. Please be there.
Oh.
If you haven't subscribed to our YouTube channel, please subscribe tonight.
Hey, don't forget the radio. Hold on, we're gonna be. I forgot. AM 1100 in Georgia. Tune in, and you can go. What's the name of the station, Marcus? I know it's AM 1100 in Atlanta.
Yeah. And the name
11 a.m.
Yeah, I forgot. It was like
It's called. It's 1100 AM radio station. It's Real Entertainment Radio. That's
Yeah.
Real Entertainment Radio.
Yeah.
All right.
Friday
So
at
Thank you.
That's
Timmy.
Friday,
Friday,
8 p.m.
8:30.
8 p.m.
8 p.m. My fault.
Yeah.
Friday, 8 p.m.
Yes.
Good.
All right.
Yeah.
So 1100 a.m. All right.
Peace
So
out.
catch us there.
You have a good
Yeah.
evening.
See y'all next week.
That's right.